Hello guys, in today's video I'm going to give you the top 6 ETFs that you will ever need, and these have the potential to one day turn you into a millionaire. You don't need to be an expert in order to invest or build wealth within the stock markets. In fact, there is actually only 6 ETFs that you actually need in order to get a well-diversified portfolio that also have the potential to make you rich. I know it sounds really simple, and that's exactly what it is. There is no reason to overcomplicate it. So by the end of the video, you will actually regret not having watched this video sooner. So let's start with number 1. Your portfolio needs a core holding, and that is where the majority of your money goes. So let's say that you have $100,000 to invest. Well, then you could potentially put 60,000 of those into this one ETF here, and thereby making it your core holding. A strategy that has proven to work again and again is having the S&P 500 index as your core holding. And that is actually what I'm also doing myself. And here is the best ETF, in my opinion, the VOO, which is basically the Vanguard's version of the S&P 500. The main objective of this ETF here, well, that is to track the performance of the S&P 500 index. And the S&P 500 index, well, that does of course consist of the 500 largest publicly traded companies within the US. Investing into this ETF does actually give the investor the potential to reap the benefits of having 500 companies within your portfolio for a very low cost. When looking at the performance of this ETF over the last year, well, then we basically see that the return has been negative, and it has been minus 10.61%. Which basically makes sense with everything that's going on right now with the inflation, with the interest rates and so on. But had you invested $10,000 into this ETF 10 years ago, well, then today you would actually have had $26,379. That means that this ETF would have more than doubled your money within 10 years without you having to do anything at all. And yes, past performance is no guarantee for future results. However, you can ask any investor you want, and they will most likely recommend you to buy the S&P 500 index, and there's a really high chance of them saying that they actually also do own the S&P 500 index. So it is a very, very solid investment. So let's talk about dividends now. Even though this ETF is not focused on dividends, well, then they are still paying dividends. They have a dividend payout ratio of 1.62%. So had you invested $10,000 into this ETF last year, well, then they would have paid you more than $150 in purely passive income within the last year alone. The second example I have is going to be the VNQ, or the Vanguard Real Estate Index Fund. So it is basically an ETF that focuses on the things outside of the stock market in order to give you even more diversification. And in this example here, it is real estate. And no, I'm not talking about putting down $50,000 in payment for a house, finding tenants, renting it out, sorting the contracts and all of that. I am simply talking about investing into REITs, or real estate investment trusts. REITs are basically companies that own and manage income producing or real estate assets. So by buying a simple share in a REIT, well, then you basically get exposure to the real estate market without having to do all the usual work there is when you own real estate. The objective of the VNQ is to try and replicate the return of the MSCI US Investable Market Real Estate 25 to 50 index. So VNQ is basically an ETF that tries to capture the return of REITs and the real estate market. This ETF does actually own more than 170 different REITs. So by simply buying this ETF, well, then you basically get exposure to all of these REITs and thereby the entire US real estate market. REITs are much like dividend paying stocks, where the goal is not necessarily to grow the fastest, but more so to pay consistent high dividends to their investors. Over the last 10 years, VNQ has given investors a yearly average return of 6.5%. So had you invested $10,000 into this ETF 10 years ago, well, then today you would have had $20,610. VNQ has a dividend yield of 3.13%, and that equals roughly $2.9 per share. That basically means that if you had invested $10,000 into this ETF 1 year ago, well, then today you would have received more than $300 in purely passive income in the form of dividend payments. The third ETF that I would highly recommend is actually an ETF that does include the entire US stock market. The ETF is called the VTI, and that stands for the Vanguard Total Stock Market. This is likely one of the most diversified investments that you can ever make. The goal of this ETF is to track the US CRSP Total Market Index, which is an index that does include both small and large cap companies and everything in between. For the average investor within VGI is basically a one-size-fits-all approach. It provides investors with a very low cost and a very easy way of getting exposure to the entire US stock market. The ETF does basically have more than 4,100 stocks in their portfolio, and it is a very good mix of both large, small and medium-sized companies. Over the last 10 years, well then has this ETF had an average yearly return of 12.48% per year. If you had invested $10,000 into this ETF 10 years ago, well then today you would have had $32,415. The ETF is also paying dividend, and the dividend yield is 1.56%. So if you had invested $10,000 last year, well then you would have received more than $150 in pure dividend payments within the last year alone. The fourth ETF on my list is basically an ETF that gives you exposure to all of the stocks outside of the US. The ETF is called the VXUS, and that stands for the Vanguard Total International Stock. It is extremely important to think of diversifying your investments, and that also means to invest in companies outside of the US. It is a really great way of actually getting more diversification into your portfolio. However, it is not necessary to do so, but it should not be underestimated. A lot of people, well, they are actually combining the ETF that I just talked about before, the VTI, with this ETF here, the VXUS, and that is giving exposure to the entire world when you do it like that. It should also be said here that you can basically buy an ETF that does track the whole world. But when you do it like this on your own, well then you can basically decide how much of your total portfolio should consist of US stocks and how much of your total portfolio should consist of not US stocks. You cannot do that when you buy a preset ETF. This ETF here includes 7,562 companies. Over the last 10 years, well then has VXUS returned investors with 5.20% on average per year. So if you had invested $10,000 into this ETF 10 years ago, well then today you would basically have had $16,600 in total. This ETF here is also paying dividends, and they have a dividend yield of 3.84, which is actually quite impressive. So if you had invested $10,000 into this ETF 1 year ago, well then you would have received almost $400 in pure passive income in the form of dividend payments. The fifth ETF on my list is the VGT, or the Vanguard Information Technology. The goal of this ETF is to track the MSCI US Investable Market Information Technology Index, which is basically an index that is made of information technology companies. Right now we are in a very bad time economically, where a lot of stocks are falling in value, especially tech stocks. But at one point, the tables are going to turn again, and that is when it becomes really fun to be an investor in tech stocks. I don't think there is anyone who can deny that technology is not here to stay, and that technology is not going to be a big part of the future. Therefore, being invested in these companies might not be a bad idea. This ETF does include 379 companies, including the world's largest tech companies. Over the last 10 years, well then has this ETF given investors a yearly average return of 18.24%. Had you invested $10,000 into this ETF 10 years ago, well then today you would have had $53,400. Even though this ETF is basically only focusing on growth companies, well then they are still paying dividends. And they basically have a dividend yield of 0.87%. So that actually means that if you had invested $10,000 into this ETF 1 year ago, well then you would have received just below $100 in pure passive income in the form of dividend payments. The number 6 ETF on my list is the VUG, the Vanguard Growth ETF. This ETF is basically tracking the performance of the CRSP US Large Cap Growth Index, which is basically trying to find the largest growth companies within the US. This ETF is a bit more high risk. However, it also has the potential to give you very, very good returns. Having exposure to growth companies in your portfolio might be a really good idea. That is the only way to make sure that you don't miss companies like Tesla within your portfolio. This ETF here does include 260 stocks. Over the last 10 years, well then has this ETF here experienced an average yearly growth rate of 14.10%. So had you invested $10,000 into this ETF here 10 years ago, well then would your investment today be worth more than $37,000. Even though this ETF here is focusing only on growth companies, well then they're actually still paying dividends. and they have a dividend yield of 0.63%. So if you had invested $10,000 into this ETF here last year, well, then you would have received just below $100 in pure passive income in the form of dividend payments in only 1 year. These were basically my 6 examples of ETFs that have the potential to make you a millionaire. I really hope that you liked today's video. If you did, then please press the like button below the video and make sure to subscribe to my channel if you want to see more videos like this one in the future. Thank you for watching.